We saw something today that we haven't seen since right at the end of the bull market in January that preceded that big sharp sell off. So we're going to see that again. I'm going to talk about how important tomorrow is to some of these technicals and where we're sitting on various charts. I'm going to break all that down today, taking a look at what's driving a lot of this weakness and how the U.S. market somehow seemingly holding up much better than probably it should, and where those areas of weakness are in the U.S. markets and how we might be able to take advantage in one. So let's go ahead and get started. Today is Monday, August 13th, 2018. This is the Market Outlook from MarketScholars.com. Thank you very much for tuning in. Appreciate those watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Click on the Market Scholars logo here, or mouse over the Market Scholars logo. Click the red subscribe button that pops out there. Also, click the thumbs up icon that's down below the video. That lets me know two things. You got something out of tonight's video, and you want us to keep doing these videos. Comment on anything that stands out to you, anything you picked up, anything you learned. Join our daily Market Outlook email list. Click the link that's popping out in the top right corner of your screen that will subscribe you to our list. Follow me on Twitter for more content like this throughout the day. And of course, join our Market Outlook community on Facebook. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You'll see everything's dropping. In fact, all four lines, if you look over here on the left, all four lines are falling. The momentum line is now in the lower reversal zone, albeit at an extreme low this time. So the first time it's dropped to an extreme low, just below the 5th percentile. But this is the fourth consecutive day that we've had a bullish intermediate confirmation signal, which is an oversold momentum line combined with a strong bullish posture defined as the green line being in the upper reversal zone. Market sentiment's falling too, and falling just below the 80th percentile, which again suggests very weak bearish market sentiment, bearish long-term trend. I mean, if you look at that as a bearish trend right there, you can see why it's about as weak of a bearish trend as you could possibly get, especially when you have the intermediate line still in the upper reversal zone. But it is a bearish short-term posture. I mean, the near-term line's dropped now kind of solidly into the lower reversal zone, and the momentum line falling below the 5th percentile. Pretty oversold short-term sentiment. Today's move basically closed at the bottom of the Fibonacci retracement zone on this near-term pullback that we're on right now. So obviously a break below. Remember, 2800 is their more significant support level, but a break below here, this 2820, will definitely put the 280 or the 2800 level into play. Remember, we expect support to hold until it doesn't. You can see why 2800 will be so important, because there's a lot of different touches. If I zoom out here, there's a lot of different touches in this area at 2800. So there will be a significant support there, and you expect support to hold until it doesn't. Something we always talk about here, especially when you have a strong bullish posture. In fact, we haven't really even broken out of this. You can see there's some old highs here. We haven't broken out of this near-term retracement zone either. So definitely something to keep an eye on tomorrow, as early as tomorrow, because if we don't bounce off of this and we break through and we kind of mess around this 2800 area and we can't hold that, then that's going to, you've got some more support down there, but the trend changes at that point. It would still be a weak bearish, but we definitely wouldn't be bullish anymore. We'd anticipate an intermediate pullback. Now, that also doesn't mean the world's going to end either, because we had an intermediate pullback right there, and it was just a Fibonacci pullback for this intermediate run that existed throughout May and June. So we are only about a month plus into this intermediate run, and considering it had a couple of clusters, especially one early, this overbought cluster, the expectations were we get to a couple. 1 month's not a bad run, but the expectations were we could probably get to a couple of months here, even with the seasonality of weakness heading into the end of August that we typically see. So that's the S&P 500. You see the Dow shows a very similar pattern. The difference with the Dow from the S&P 500 shows still a strong bullish posture, oversold oversold short-term sentiment, but you can see we're a lot closer to that near-term low point. In fact, we haven't broken below its low, but we've got a lower close this time. That's a little different than what we're seeing on the S&P 500. So a little bit more bearish of a pullback on the Dow. So that's going one direction. Going the other direction towards the small cap area, you can see the Nasdaq also shows a bullish intermediate confirmation signal. Same thing, bullish posture, but like the S&P, not nearly as close. And in fact, even better than the S&P, is pulled back to the top end of that Fibonacci retracement, more so than that 62% Fibonacci that the S&P has pulled back. Finally, the Russell 2000, it shows the biggest red flag out of all of these. It hasn't broken out of this little sideways consolidation yet to the downside, but that intermediate line's turned down and now shows a bearish posture. So it shows a bearish posture. It just barely started this intermediate run. The intermediate line just barely turned up above 50. You kind of had a short run here. Intermediate run did not get up to new highs. It did pull back to a higher low. And if this ends up being the end of this current intermediate run, that's a very bearish sign. You'd expect a break below here and moving down. So again, we're kind of expecting, if we don't bounce here in the next day or two with stocks, then there's going to be some weakness felt in the U.S. stock market here. That, again, would jive with the seasonality, but would be a red flag from a market forecast perspective because we're not meeting what we expect to see. And when you don't meet what you expect to see from a bullish standpoint, that ends up being pretty bearish. So definitely something to keep an eye on, again, as soon as tomorrow, because we're pretty much right on support levels with today's close. So depending upon how we bounce, or if we bounce from these oversold short-term areas, will dictate what to expect in terms of whether these intermediate runs that we're currently on are finished. A reminder that you can watch our Market Outlook video from our blog by clicking on the link in the Market Outlook tweet or anywhere else you see on Facebook, where we post on Facebook. It takes you to our blog post. You can see our schedule of classes coming up here on the right. You can also subscribe for free to our Market Scholars page. It doesn't get you access to our premium classes, but it does give you access to participate in our Market Outlook forum, so you can ask questions, comments, and basically communicate with our community, our Market Scholars community here. We do ask, if you want us to keep doing these videos, you can do this right now while you're watching. Give us 3 clicks. That's the feedback we're looking for that tells us, yes, you want us to keep going with these. One is to like the Market Outlook tweet right there by clicking on that heart, and then it pulls up your Twitter account. Might have to log in, but you'll hit like right there. Second is to click on that Facebook post. It takes you to your Facebook page where you can like the post from there and also share it if you'd like. And then finally, the third one is to like it here on the blog. And the more we get the shares, whether from up here or down here, we can get this number up. We're looking to get that number up to 100 shares. And that goes a long way towards recommending the Market Outlook to anybody and everybody because of how the algorithms work for these social media networks. All right, going back to our charts, you can see the pullback here in context, still above a rising 50-day moving average, still above a rising 200-day moving average. Both lines still, the gap between the both lines still rising slowly from last week. Now remember, we're only a day into this weekly candle, so definitely something to keep an eye on considering we had one bearish week last week, and do we end up having something like this again that we had about 5 or 6 weeks ago. So, but still bullish trend. So again, that's why if we're going to have a bias, it's still going to be to the upside, simply because that's what the long-term trend dictates. And you look at the 3 green arrow chart here, and you can see we've got 2 red arrows now. We're still above a rising moving average, so that line's still green. You see when it turns something else, that's when you have your bigger pullback. See, that was an intermediate pullback on the market forecast. This was a much deeper intermediate pullback. But when it's green and stays green, even if it's just maybe a little small dip of yellow there, you're okay. You're still on this bullish trend even with 1 or 2 red arrows. All right, when we look at the two-line versions of the three green arrow chart, you'll see the divergence setting up, and that's another sign that puts that 2800 in play, because that would be a target level, the low points in between the two highs that you'd target. Now, we are a smidgen below the 17-day moving average now, and we're moving down towards the 30. MACD and stochastics both dropping below their moving averages. So again, bearish in the short term to a point where, if we don't bounce from here and hold that 17-day moving average, similar to what we saw right there, then there's a chance that we might be more bearish down to that 2800 level. And of course, breaking 2800 would signify a change in trend, right? That would be more of an intermediate pullback. Probably won't get the intermediate line below 50 unless we break below that 2800 level. Here's another reason why if we don't bounce here, we might be more bearish, because we are at the midpoint of the four-week range. That midpoint's going to change here in another day or two, just a little bit higher. So if we don't hold this support area on a near-term basis and bounce, and that midpoint doesn't hold, then we start trading in the lower half of the range. Again, that will lead to more of a bearish intermediate posture. And again, once you start breaking below this 280, which will be a significant support level, then that's when we'll start looking at more of an intermediate term pullback, with that intermediate line crossing below the midpoint and heading lower. So very, very important day, like I said, as soon as even tomorrow. And like I said, considering the long-term trends, the three green arrows, the moving average rising, we would lean and bias to the upside. That doesn't mean it's going to bounce, but that would be, if you had to guess one way or the other right now, unless you are just very pessimistic, the long-term charts would tell you that you would expect it to go up and bounce off this level rather than break. But again, we'll find out again as soon as tomorrow. And if we do break, then we'll start to get a little bit more bearish until we break below into new 4-week lows, which we haven't had a new 4-week low, really since this back here, and that was when it was rising. So we haven't pushed down to a new 4-week low in quite a while. You can see we're using the price channels here. The last time that we dipped to a 4-week low point was right here. We pushed that 4-week low channel down, was right here. We had a brief little dip our toe in the water right there on an intraday basis to a new 4-week low point. So the line dropped down a little bit there. But really, from this point going forward, we had been moving up. We did nothing but move up on the 4-week low point, and also moving up on the 4-week high point too. So there's our channel that you see on the other chart, and it's so far still pointing higher, and we haven't pushed to a new low point yet. But to do that, the first thing you have to do is trade in the lower half of the 4-week range. And once you get in the lower half of the 4-week range, then it becomes an issue. As we saw before, our range today was 2.39 points, so just a little bit above the average range of over 2 points. Volume was also just a smidgen above average at 65 million. So 2.39, 65 million. If you take a look at the averages here, 2.39 is right there. So it's still in the lower half of the 52-week range, just a smidgen above the average. The volume at 65 million is also well below. So this is not significantly bearish volume in trading ranges. They are a little bit above average, but it's when you get into like this midpoint, this mid area to upper half. If we get really strong numbers that are higher than these 52-week ranges, like above 5 points, like all at once, then that's like, those kind of moves don't last very long. But if we start consistently getting higher volumes and bigger ranges, 3 points and higher, that's when we say, okay, we're going to start being more bearish. So considering that the relative ATR is still well below 1%, you still don't have, and it hasn't started to rise yet consistently, heading into a break that eventually we had. We're still not too concerned about an imminent breakdown because of the bullishness that we're seeing in the charts. And finally, we'll look at the volatility. Where's that volatility chart? There we go. We got up to 15. This is a significant level, the 15 level. You can see it can act as over here is acting as a support. We broke up above it a couple of times. Here is support again. We broke up a couple of times. It was resistance before, but we used 20, and now we broke below 20. We broke below 12. We broke well below 12. So this bounce up to 15. Is this going to now act as a resistance as we've done before? When we were in a low volatility environment similar to what we've been currently experiencing. So that's something to keep an eye out. You look at the relative volatility, so the VIX to VXV, and we're just poking our toes here in the neutral range, in the bottom of the neutral range. Getting up above 95% is now more bearish. This is the more bullish range. So again, as soon as tomorrow, we'll find if we come back into the bullish zone, great on volatility. If we break up above 15 and break up above 95%, now we're going to be more bearish, and that could lead, depending upon what the charts show us, that can definitely lead to more bearishness and might make a VIX run up to 20. All right, so to summarize, we still have a strong bullish posture, but it's very tenuous in terms of as soon as tomorrow we may break some of this short-term support and start looking at more of a bearish intermediate posture. That still wouldn't be significant, but could get down to that point. So, and again, considering the long-term trends and the intermediate trends, the bias would be to expect it to bounce here tomorrow off of these levels, off that VIX level, off these short-term levels. But that doesn't necessarily mean it has to happen. Especially in short-term technical analysis, the odds of guessing right aren't necessarily the highest. But you have to have an expectation. Our expectations are based off what the charts are showing, but those expectations will start to change if we start breaking these levels on volatility, if we start breaking the short-term levels on price, we start breaking through this Fibonacci retracement zones and into the lower half of the 4-week range. All those kind of bearish factors will start to add up to more of a bearish posture than we've had for a little bit of time. So, to follow up on that, now I want to hear what you think. So there's a poll popping out in the top right corner of your video. Click on that link up there and click on whether you agree with this summary of our market posture or not. If you disagree, which is perfectly fine, scroll down to the bottom of this YouTube channel and let me know. Tell me what you're seeing that either would suggest that we already should be more bearish because you're seeing this evidence or that evidence, and share that way. I would love to see what you're looking at. Or maybe you think we're actually, this is more bearish than you are. You're a lot more bullish than this because you're seeing some other things too. And feel free to share those as well. All right, now let's transition to what's driving the action today. There was nothing on the calendar significant. There were some earnings announcements that had some impact on individual stocks. But from a broad market standpoint, nothing significant here. And as a result, it was actually kind of a light move. I mean, yeah, we were down today in stocks, 0.4%, and same with small cap stocks, but the reality is, and we were pretty flat. There's only one thing that was up today. Of course, it was the U.S. dollar, and it still holds a high position after the strong move on over here down in the bottom left. After a strong move on Friday, you could have put pressure on gold to new 3-month lows, put pressure on ag commodities to 3-month lows with their impact on from tariffs. And then crude oil obviously dropping too, coming up off of its lows today. There's the candle for today. So bond prices are rallying a little bit during this short-term pullback. You can see their moving averages are all still pointed lower. High yield's the only one that has a rising moving average, because remember, high yield bonds behave very similar to stocks and how stocks perform, and that's what we see up here at the top. The only equity asset class that's lagging or underperforming is preferred stocks. Everything else has got a rising, in fact, dividend stocks and MLPs have strong bullish posture still, and they're above rising moving averages. So, you can see kind of who's winning and who's losing right now, and commodity, emerging markets here, gold, commodities, ag commodities, the DBC commodity, crude oil prices, all lagging behind, and it just kind of shows that this is a strong dollar move, and that's what's really dominating price action, is how that dollar is moving, how it's putting pressure in all these areas. And you remember, like, you look at commodities typically go up in inflationary environments, and when the economy is growing, kind of a reflection of growing economic growth expectations as well. And so I mean, if you take a look at that's DBA right there, DBC, you can see it's also on a downward trend and moving lower. Just very similar looking chart to what you're seeing here on crude oil. And if I were to zoom out to a year's chart, we're pulling back to a 38% Fibonacci retracement on a long-term basis here. You can see there's your move that we've pulled back to on the strength of the U.S. dollar, and now the question is, are we going to bounce off of this support at that 38% Fibonacci, if not the 50% Fibonacci lines, and bounce up? There's a few long lower shadows that we're seeing here on a weekly basis to see if we end up closing below that or not. And as of right now, we haven't, and this is one day into this week's candle. So important for this to bounce back up if we expect economic growth to continue, and if we expect see economic growth to be a reflection of this as well, which would also be inflation expectations would be kind of increasing rate hike odds too, and they're down a little bit from what they were, up a smidgen from Friday, but down from a week ago. So you can see these inflation or these interest rate hike expectations, although they are still relatively high at 60%, are dropping right now. So that's not typical of a good bullish economic environment or economic growth or inflation expectations, and those are the factors that generally lead to a maturing bull market, and so right now we're getting a little bit of a pullback. Now, just a pullback. You can see we peaked over here too in June and had a little bit of a decline before taking off all in July. So we'll see how much of a pullback this is, and if that gray line gets back below the red, then there's going to be a little bit of cause for concern if we don't get that next rate hike in December, where we've been expecting it for a while now. If we end up not getting it, then that says something about how bullish our economic environment is and how bullish economic growth is expected to be. We don't get a new release until Wednesday, but you can see we're still at 4.3%. That's still a pretty strong number coming off of a strong number in Q2. You can see, by the end of the day, the S&P actually was one of the better performing asset classes. Brazil really bounced off of its lows, and so did Russia coming off of its lows. But you can see things dropping. India's dropping a second straight day. Japan continuing to drop. Germany continuing to drop close to new 3-month lows. China dropping. Korea dropping 2 new 3-month low points. So, as bearish as we may seem here in the S&P, the Brazil, it's a nice little bounce, and Russia is at its 3-month lows, considering those are your two best performers. You can also see France, holding after a big break on Friday. Canada is probably your bet outside the U.S., kind of your better performing over the last couple of days. You had such a big drop in India really fast here, so this kind of puts in perspective. We're getting a little bit of a decline in the S&P, but we're getting much bigger and more major declines elsewhere that haven't caused more of a decline yet. Considering that that's all we've had, when most of these other major economies are at their 3-month lows or worse, with double-digit return or double-digit losses over the last 3 months, and the S&P is only showing that much of a loss, again, kind of puts in perspective just how bullish we are. That we're not also joining them with those types of declines over the past few months. Thanks, of course, to the strength of that U.S. dollar. All right, if you take a look at the sector rotation, you see we have safe haven areas like utilities, staples, healthcare, real estate all rallying more than the S&P 500. And your tariff-related sectors, industrials, materials falling, financials continuing to fall. In fact, you can see here's the S&P 500. Here's all the sectors that are kind of doing really well right now relative to the S&P. Strong bullish postures, 85, 94, 80. Staples is pulling back a little bit, so it's got a weak bearish posture. And then there's your technology and real estate kind of keeping up a little bit, not really getting up to new highs like some of these other ETFs are. But then you've really, you can see which ones are really lagging behind. Industrials and materials, two of your worst ones. There's your telecom sector. Energy close to 3-month lows. Financials really pulling back strongly below the prior near-term low point. So You can kind of see where the weakness is, and that continues to be some weak areas, even with recent strength in industrials. But you can see they've got the bearish postures, and financial soon to be a bearish posture, kind of joining staples and real estate here on their pullbacks, where your strength continues to lie in discretionary and healthcare, and a little bit in the utility sector as well. One stock in that financial sector, one of these weak areas, the financials, you can see down here, the second worst sector of the past 3 months. You can see that the short-term sentiment looks very similar to what you see on the broad market as a whole. The difference is the posture is already bearish and strengthening, not below 50 yet, and we obviously run a much more bearish trend here. With the intermediate line dropping in March and staying down below 50, and we had a little bit of a run up, but considering here the Fibonacci retracement from one end down to the other, we basically got up to the 38% Fibonacci level and started to roll over now, getting back below the moving average, getting back below 230, gapping down there on Friday, continuing lower to a new low today. With very extreme low momentum line and oversold oversold near-term line. You can see obviously we have 3 red arrows. If you take a look at the 2-line versions of this, you can see that the MACD and stochastics are both crossing below their midpoints, below their moving averages. The MACD crossing below its midpoint means that the 8 days cross below 17. That's the green lines cross below the red. And now again, if both lines cross below, similar over here, if both lines cross below 30, then there might be a bounce back up, a return move, but the trend could continue lower with this kind of weakening financial sector. So definitely looks like we had a bounce off of a lower low point, and there could be an inverse head and shoulders pattern developing at some point. But you notice that the charts just look bearish, and we're getting really close to that lower band after trading above the upper band for so long, breaking down below now a falling moving average and trading closer to the lower band with no volume down here to hold it up. I mean, there's a couple of touches in the past year, but the volume has been so light in these areas that there's more volume that we're clearing through right now. We hit an area of volume for resistance. We've gapped through an area of volume right now, and we're trading kind of at the bottom end of that with no significant amount of volume holding it up. So there's potential for the stock to continue to roll to the downside. And you look at the DMI, and the DMI negative line is turning back up. Oh, excuse me, that's MACD. Let's go back to GSA. It did turn out, and you can see the negative line did jump back up here yesterday and getting back up above the 25 level with ADX above 20, which means that we got a strong enough trend to continue to move. So, that's you got a bearish setup on Goldman Sachs, and you look at, right now your 230, 235 call spread. It's pretty rich. You're getting a lot of premium for a $5 wide spread. Usually you're looking for about 30% return on risk, and that would give you about $1.16 on that. So you've got a lot of credit here, way more than $1.16. Of course, your delta's at 42. You look at when you analyze that, it was actually $1.66 here. Throw that break even, set slices of break even, and throw that onto the chart, and you can see that's where basically the gap down we had on Friday. Your break even is at that gap, and of course you've got some room above that. You'll just getting to that level, you'll lose about half of what you're trying to make. This crossover point, which is at 232.5, so kind of in this area, right just above that line. So as long as we stay below that line, you have a good profit loss ratio, and if you get above that line, then you're able to take off, get out of the trade with a smaller loss, and you've got some more room to work with before you get that 1-to-1 reward to risk ratio. And I say 1-to-1 because you're either going to get max credit or you're going to lose, because that's as much of a move you have on the stock to get any kind of reward that's not max credit. So you're going to get either maximum gain or you're going to get a loss in this trade. And if we can keep that loss to a good 1-to-1 reward to risk ratio, knowing that you got decent odds of getting a gain, and the chart's pointed in your direction, then we end up with a good reward to risk environment to make a trade, to make the risk worth the trade. All right, so what do you think about tonight's market posture? What do you think about tonight's trade idea that we have on Goldman Sachs in this weakening financial sector? Let me know. There's a link popping in the top right corner of your video. Click that link. That will take you to our Market Outlook forums on marketscholars.com. And there you can be able to comment on it and be able to interact with other market scholars on what you're seeing in tonight's market outlook. As always, thank you very much for tuning in. Don't forget, subscribe to our YouTube channel. Click the thumbs up icon. Let us know you want us to keep doing these. Comment on the video. Follow me on Twitter for more content like this. And join our community on Facebook, Market Outlook community. As always, thank you very, very much for tuning in. And we'll see you all next time.